JSW Cement is going public, and it's making a huge bet on being green. But in one of India's oldest, toughest industries, can an eco-friendly pitch actually build a profitable company? That's the billion-dollar question we're going to dig into.
So let me ask you something. When you think of booming industries, what pops into your head? Tech? EVs? AI? Yeah, I'm guessing cement isn't at the top of your list. It feels kind of old school, right? But if you overlook it, you might be missing a massive piece of the puzzle.
Because really, nothing tells a country's growth story like cement does. It is the literal foundation of an industrial boom. Every single skyscraper, every highway, every metro line, it all starts with this simple gray powder. So to really get what JSW is trying to do, we have to understand the world they're operating in.
Okay, part 1, India's concrete foundation. Before we can get to JSW's big green bet, you need to understand the business it's in. And trust me, cement is one tough, gritty business.
First off, it's an incredibly expensive process. You have to mine limestone, then you fire it in these enormous kilns at a blistering 1400 degrees Celsius. That creates these hard stones called clinkers. And then, those are cooled, blended, and ground down into the fine powder that we all recognize.
So where does all the money go? Well, get this. A massive 30% of the cost is just fuel and power. Another 25% is spent on freight and logistics, just moving this heavy stuff around. Think about that for a second. Over half your costs are already locked in before you even factor in the raw materials themselves. It's a recipe for razor-thin profit margins.
And all of this means the cement business is a game of huge scale and just ruthless efficiency. Building a new plant costs a fortune, the product is way too bulky to ship far, so all the markets are intensely regional, and since customers, let's be honest, buy on price, not brand, the moment one company cuts its price, it triggers this industry-wide race to the bottom. This is the brutal landscape JSW is trying to conquer.
All right, part 2, JSW's green cement pitch. So how does a newer player even plan to compete in a market this brutal? Well, JSW's answer is pretty unique. It is all about going green.
And they're not messing around. They are backing this ambition with a massive 3,600 crore rupee IPO. This isn't just about raising cash. It's a declaration of war. They intend to expand nationally and take the industry giants head on.
So what exactly is green cement? Well, traditional cement, right, it relies on mining and burning limestone, which, as you can imagine, creates huge CO2 emissions. JSW's green cement, on the other hand, uses steel slag, which is basically an industrial waste product. And thanks to its sister company, JSW Steel, it has this captive, low-cost supply of its main ingredient. Pretty smart.
And this is not just some little side project for them. JSW completely dominates this niche. They command an incredible 84% market share in what's called ground granulated blast furnace slag, or GGBS cement. This is their entire identity.
You can see the strategic advantages here, right? It slashes their CO2 emissions, which is great for the planet and, their brand. It cuts the reliance on expensive limestone, and maybe most importantly, it positions them perfectly for a future where buyers demand strong ESG, environmental, social, and governance credentials.
Okay, part 3, a crack in the financials. Now, it's a really compelling story, isn't it? A green tech company taking on this old world industry, but, and this is a big but, this is where the narrative takes a very sharp turn. Because a great story doesn't always equal a great balance sheet.
As one analyst put it pretty bluntly, a green pitch is one thing, but profitability, that's a whole different ballgame.
Just last financial year, JSW Cement posted a net loss of 164 crore rupees. Wow. That is a massive reversal from a 131 crore profit just the year before. So what on earth went wrong?
Well, it's really a mix of industry-wide problems and their own growing pains. They're locked in these brutal price wars in the South and West, and without a national footprint, they can't really set prices. So when fuel and freight costs shot through the roof, they just had to eat that cost. And all of this is happening while they're spending tons of money to expand.
Let's use a simple analogy here to understand another key problem. Think of their factories like they're giant restaurant kitchens, okay? So,
If your kitchen is built to serve 100 meals an hour, but you're only getting orders for 60, you're just not being efficient. Your expensive kitchen is being underutilized.
And that's exactly JSW's problem. Their capacity utilization is just sitting at 63%, which is well below the industry average of 72%. To put it simply, their expensive factories just aren't running busy enough to cover their own costs.
So this brings us right to part 4, the price of ambition. This green growth story, this rapid expansion, it comes at a significant cost that every potential investor needs to see clearly.
And that cost is debt. A lot of it. The company is carrying over 6,100 crore rupees of debt on its books. That is a heavy, heavy burden for a business that isn't currently profitable, especially when a good chunk of the IPO money is already set aside to pay down some of that debt and fund even more expansion.
So how in the world do you value a company like this? It's losing money, so the classic price-to-earnings ratio is basically useless here. Instead, analysts use a different metric called EV to EBITDA. Now don't worry, it's simpler than it sounds. It's just a way of looking at a company's total value, debt included, and comparing it to its operating profit. It's just a better tool for comparing these capital-heavy firms fairly.
Now, on the surface, the valuation seems fine. At the IPO price, JSW is valued at around 23 times its operating profit, which is right in line with the industry average. But, and you knew there was a but coming, here's the critical catch. You're being asked to pay an average price for a company that currently has below-average performance, lower margins, smaller scale, and less efficient factories. You're paying for the promise of the future, not for the results of today.
Which leads us to our final section, Part 5. Bet on the future or the present. Really, all of this boils down to one critical question for any investor. Are you betting on the company JSW Cement is today, or the one it promises it's going to become tomorrow?
So here's how it all breaks down. The bull case, the argument for the company, is all about the future. It's a strong growth story, it's green and ESG friendly, they've got a pan-India expansion plan and that captive raw material access. The bear case, on the other hand, is rooted firmly in today's reality. The company is losing money, it's saddled with a ton of debt, and it's struggling with efficiency in a really brutal market.
Ultimately, this IPO isn't really a bet on a story, it's a bet on execution, pure and simple. If, and it is a big if, JSW can pull off this expansion, become more efficient, and manage its debt, it could absolutely be a defining green player in India's future. But if it stumbles, the weight of its own ambition could crush it. So the question for investors is this: will this green strategy actually cement future gains, or will it just pave a road to more debt?